In the world of cryptocurrency, Bitcoin has long been regarded as the leader, an emblem of decentralization, freedom, and innovation in the financial world. But in recent weeks, Bitcoin has experienced a major crash, and many are asking, what caused it? While market fluctuations are common, this crash is different. It appears that manipulation from large institutional players or coordinated efforts might have had a significant role to play. In this video, we'll explore how manipulation can crash Bitcoin's price, why it's so dangerous, and what this means for the future of cryptocurrency. We will also dive into the consequences for regular investors and how the situation can be navigated. If you're a Bitcoin enthusiast or investor, this video will provide valuable insights into how to protect yourself and understand the market forces at play. Stick around to learn what has happened and how you can stay ahead of the game. Bitcoin's surge and fall. A brief overview. Bitcoin has had a turbulent history when it comes to price fluctuations. From the euphoric highs, where it crossed the $60,000 mark, to its significant falls, Bitcoin's price movements have often been unpredictable. However, recent events have shown a pattern that seems less about organic market dynamics and more about manipulation from large entities in the financial space. Institutional investors, whales, and even governments have been accused of influencing Bitcoin's price, and the latest crash has many people wondering if these entities were involved in a concerted effort to manipulate the market. The story is not just about Bitcoin. It's part of a larger conversation about how markets, including cryptocurrencies, are increasingly susceptible to large-scale manipulation. How market manipulation works. Market manipulation is a powerful force in traditional finance, and it has become even more prominent in the cryptocurrency market. At its core, market manipulation is about artificially controlling or influencing the price of an asset to benefit a particular group, often at the expense of the general public. One of the most common methods of manipulation in the Bitcoin market is whale manipulation. A whale is an individual or institution that holds a significant amount of Bitcoin. By making large buys or sells, these whales can significantly affect Bitcoin's price. For example, a whale may decide to sell a large portion of their Bitcoin holdings at a particular moment, triggering a chain reaction where other traders panic and start selling off their holdings as well, driving the price even lower. This can cause a flash crash, where Bitcoin's price suddenly plummets. Another form of manipulation occurs through coordinated trading, where several whales or institutional players work together to influence the price of Bitcoin. They can create the illusion of a price trend, either upward or downward, by executing large trades at carefully timed intervals. This type of manipulation can fool smaller retail investors into thinking the market is moving in a specific direction, causing them to buy or sell based on false signals. Understanding these tactics can help protect yourself in times of market volatility. Quiz time. Which of these is not a common method of market manipulation? A. Whale trading. B. Coordinated pump and dump schemes. C. Insider trading. D. Organic market demand. Drop your answer in the comments below, and a random winner will be selected to win an Amazon voucher. Good luck. The role of media and social sentiment. Aside from whales and institutional investors, media and social sentiment also play a major role in Bitcoin's price movements. In recent years, Bitcoin has become a mainstream topic, with media outlets often covering major price movements. Positive media coverage can trigger a surge of retail investors entering the market, driving the price up. Conversely, negative news stories can create panic and cause prices to plummet. Social media platforms like Twitter, Reddit, and even Telegram have become breeding grounds for hype and manipulation. Rumors, fake news, and exaggerated statements can cause panic selling or buying. In some cases, influencers or even coordinated groups can drive sentiment by spreading misleading information. This can lead to wild price swings, making it difficult for average investors to predict where Bitcoin's value will go next. As we saw with the GameStop saga in early 2021, social media can also be a tool for coordinated action. A similar situation could unfold with Bitcoin if a group of influential individuals or institutions manipulate social sentiment for their own gain. The impact on retail investors. For retail investors, Bitcoin's latest crash has been a wake-up call. Many individual investors enter the market with the hope of striking it rich, only to find that the market can be rigged against them. The reality is that Bitcoin is a volatile asset. And unless you understand the forces that shape its price, it's easy to get caught up in the hype and the fear. When large institutional players or coordinated groups manipulate Bitcoin's price, it can cause massive losses for individual investors. Many of them buy Bitcoin at inflated prices, only to sell in panic when prices fall. This is often referred to as buying high and selling low, and it's a recipe for financial disaster. So, how can retail investors protect themselves? The key lies in education and a long-term mindset. Instead of trying to time the market, it's essential to understand the fundamentals of Bitcoin and the forces at play. By doing so, you can avoid getting swept up in the hype or panic of the moment, the regulatory landscape and its impact. In response to concerns over manipulation, several governments and regulators have started to take a closer look at the cryptocurrency market. Regulations are often seen as a double-edged sword. On one hand, they can help prevent manipulation and bring greater stability to the market. On the other hand, over-regulation could stifle innovation and hinder growth. The role of regulators in the Bitcoin market is still evolving. Some countries, like China, have cracked down on cryptocurrency trading, while others, like the United States, have implemented more cautious approaches, allowing Bitcoin to flourish under a regulatory framework. However, many critics argue that the lack of clear regulations has allowed bad actors to manipulate the market freely. As governments around the world start to implement regulations, the hope is that it will help create a more level playing field. Bitcoin's price volatility may calm down, and the market will become less prone to manipulation. This, however, remains a work in progress, the future of Bitcoin and cryptocurrency markets. So, what does the future hold for Bitcoin and other cryptocurrencies? Will market manipulation continue to play a role in price crashes, or will greater regulation bring stability to the market? The truth is that while manipulation is likely to continue in some form, Bitcoin's underlying technology, the blockchain, remains incredibly resilient. As more institutional investors get involved, and as blockchain technology continues to mature, the market may become less susceptible to manipulation. However, that doesn't mean Bitcoin will become completely stable. As with any financial asset, Bitcoin's price will continue to be influenced by a variety of factors, including market sentiment, global economic conditions, and regulatory changes. The key takeaway here is that Bitcoin's volatility is not necessarily a sign of its failure, but rather a natural part of its development as a new asset class. For investors, this means that while the market can be manipulated, there are still plenty of opportunities to profit if you have a long-term mindset and understand the risks involved. Conclusion: Bitcoin's recent crash serves as a stark reminder that the cryptocurrency market is still vulnerable to manipulation by large entities. While Bitcoin has incredible potential as a decentralized financial system, the reality is that market forces, whether it's whales, coordinated trading, or media hype, can have a huge impact on its price. For retail investors, it's essential to stay informed, understand the forces shaping Bitcoin's price, and adopt a long-term perspective. By doing so, you can protect yourself from the negative effects of market manipulation and position yourself for success in the ever-evolving world of cryptocurrency. As we continue to monitor Bitcoin and the broader cryptocurrency market, it's important to stay vigilant and adaptable. The market is still young and prone to rapid changes, And while manipulation may still be a concern, the underlying technology of blockchain continues to evolve. With greater awareness, education, and the right strategies, investors can not only weather market crashes, but also capitalize on the long-term growth potential of Bitcoin. The future of cryptocurrency holds immense promise, but it's essential to approach it with caution and a clear understanding of the dynamics at play. We hope this video has helped you gain a better understanding of the current state of Bitcoin and the role manipulation plays in its price movements. Stay tuned for more content on how you can navigate the crypto space with confidence. If you like our video, do like, comment, and share with your friends and family. And do not forget to hit the bell icon to stay tuned for more latest updates.